How is everyone doing? Welcome to the Strategy Room on this Friday night, August 8th, 2025. I thank so much for being here with me on this Friday night. Normally, we do this on Saturday night at 8 o'clock, but I've got kind of a big family event tomorrow, so I was not able to bring it on the Saturday night like I usually do. So I figured we'd do it here on Friday night at 8 o'clock. So I thank everybody for joining me. We have got a ton of stuff to go over. You would think kind of mid-August. Usually this is kind of quiet time of year where people are on vacation and not really a whole lot going on. Like, no. And we could probably thank President Trump for that. He just keeps, delivering the news every week. We've got obviously a ton of stuff, whether it's tariffs or what's going on with the Intel CEO or what's going on with the executive order on debanking. We got some open banking news I got to share with everybody tonight. I mean, we've just got a ton of information and stuff to go over with everyone tonight. So I will hop into it as we always do every week, just checking on the U.S. debt clock here. So still over 37 trillion in national debt, still have a little over a $2 trillion federal budget deficit. The Doge clock is at $587 billion with savings per taxpayer now at $5,229. Our debt to GDP ratio is still hovering in at 123%. Again, not very good numbers. So we're going to have to hope that the Republicans get serious about doing some cutting some spending here in September, but I am not going to hold my breath, and neither should you. So, but we'll see what happens. But that's, again, those are our numbers for the moment. Not much has really changed over the last few weeks, but like I said, I always like to start off just letting you know, set the stage for where we're at. Okay. I got some bank M&A that I want to open up here with for a couple of minutes. So the largest bank M&A deal was actually announced this week. Prosperity strikes priciest bank deal of 2025 with American Bank buy. So Prosperity Bankshares Inc. returned to bank M&A came at a very high price tag with a deal value to tangible common equity, otherwise known as a TCE ratio of 242.1%. The Houston-based bank's planned acquisition of Corpus Christi, Texas-based American Bank Holding Corp is the most expensive whole bank deal announced so far this year and sits well above the 150.7% median for bank deals year to date. It is also serial acquirer Prosperity's second most expensive buy of its last 10 whole bank acquisitions by that metric, according to analysis by S&P Global Market. American Bank's strong deposit base was likely a factor in the elevated price, equity analysts said. American Bank had 2.29 billion in deposits at June 30th, with 27.1% classified as non-interest bearing. According to market intelligence data, its cost of interest-bearing deposits was 2.31% in the second quarter. And it was stated in an acquisition, the most valuable part of a bank is the deposit franchise. DA Davidson analyst Peter Winter said in an interview with Market Intelligence. So again, great news to see. Now, why is this important? Why did I want to open up with this? Because obviously it's the largest bank deal so far this year, but it also leads into the next couple of articles that I'm going to show you about the M&A market is finally starting to thaw. And we're seeing, the regulation of banks has a big role to play in that. And that takes us into our next article here. So credit union bank deals begin to heat up as M&A bounces back. So similar to traditional bank M&A activity, credit union acquisitions of banks have surged recently. A wave of 3 such deals announced between July 22nd and July 25th boosted the year-to-date total to 12, 7 shy of 2024's record year. As of July 30th, target assets totaled $4.79 billion among the 12 targets, about half of the $9.10 billion total in 2024. But M&A between banks has been increasing, with July recording the highest monthly number of deals since June of 2021. Advisors expect this intensity to extend into credit union bank deal making. Now, and I want to show you this good little chart here. So we can see last year we had a record number of bank acquisitions by credit unions. So in other words, credit unions buying banks. We had a record number last year of 19. This year so far, we're at 12. I would expect that 19 number to be challenged by the end of the year. I would not be surprised one bit to see another, 12 or 15 such credit union buying bank deals before the end of the year here. I would probably expect to see a flurry in the fourth quarter. And obviously that is, that's huge on banks' radars. Obviously, banks are not happy at the moment about credit unions buying banks because it gets into the whole, credit unions have an advantage because of their tax exempt status. And that's something I've talked about over the last year. I've talked about it in a number of episodes. You could go back and check some of the episodes that I've done on credit unions buying banks that I've probably done over the last 7-8 months. So it's a big thing. Banks don't like it. Some of the states have basically tried to slow it down, but it gets back to the heart of like I said, the tax exemption that credit unions enjoy. And it's basically like, well, the credit unions, they got those tax exemptions in the first place because they operated in a certain fashion. Like, in other words, your typical credit union years ago was something that supported a certain group of people, maybe a union or a school, and they were maybe open Mondays, Wednesdays, and Fridays from 11 to 3 or something like that. Now you've got the credit unions that basically walk, talk, act, operate, look exactly like a community bank would look, and these credit unions are not small. They're $3, $4, $5, $8 billion in assets. It's like, and so, it just begs the question. If it looks like a duck, it walks like a duck, it quacks like a duck, it must be a duck. Therefore, should that duck still have a tax exempt status? That gets to the heart of the question there. And again, a lot of bankers, a lot of banking associations like the American Bankers Association, ICBA, they have brought a lot of awareness to this issue, basically saying like, hey, these credit unions are growing very nicely. They're acting just like banks now. They're buying banks. Like, so what's going on with all this? So definitely more information to come on this one. And then going in here, so regional bank M&A expected to get a boost from Fed rating proposal. So a recent Federal Reserve proposal is expected to make it easier for regional banks whose deal-making appetite is on the rise to engage in M&A. The Fed's proposal is set to alter the regulatory rating system for banks with over $100 billion in assets, making it easier for them to obtain a well-managed rating. Currently, just one deficient or -1 rating, the next to last on the scale of 4, would deem a large bank not well managed. However, under the proposal, a bank would need 2 or more deficient 1 ratings to be handed a not well banking rating. The proposal would maintain the current standard of which a bank with any deficient 2 rating, the bottom of the scale, would be deemed not well managed. Since a favorable regulatory rating is a key component in obtaining a green light on growth initiatives like M&A, the proposal expected to open the door for large banks to merge, said advisors and analysts. It definitely shows you that there's a willingness to entertain M&A at the $100 billion and above level. Claros Capital Managing Director Kevin Stein, a former associate director at the FDIC who worked on resolutions and a bridge bank, said in an interview, under the prior administration, they weren't invited. He added, it was frowned upon. The proposal comes at an opportune time for regional banks who are feeling more confident in deal making after the change in administration and recent large bank deal announcements. So, and then what were some of those? Well, last month, Huntington Bancshares announced a $1.84 billion acquisition of Veritex Holding Inc., making Huntington the largest bank buyer in 4 years. Less than 2 weeks later, Pinnacle Financial Partners and Synovus Financial announced their merger of equals that will create a bank with over $115 billion in assets. It is also the largest U.S. bank deal announced in nearly 4 years. So more large deals will come down the pike if the proposal is finalized, advisors said. Regulators are trying to be a little bit more facilitating rather than obstructing. John Gorman, partner at Luce Gorman PC, who represents financial institutions on M&A, regulation, and other topics, said in an interview. Again, this is all the easing up of regulation as it relates to bank M&A. And again, it's a little, again, because it's trying to describe this, right, as a loosening of bank regulation, but it's not necessarily that. I just look at this as more of a going back to normal, as opposed to a like unraveling or deregulatory type of environment. It's not that you're getting rid of regulation, you're just, government is just getting out of the way to allow things, or the market, the bank M&A, especially the bank M&A market, to just operate like it normally would. That's really all that's happening here. But you have to describe it in a certain fashion, and I would describe, again, deregulation is kind of a fashion word, I guess, so to speak, and trying to describe this. But like I said, I look at it more as just a returning to normal. As it said right here in this article, that for larger banks, banks that were 100 billion or bigger, they weren't invited to the party. They weren't allowed to entertain M&A. It said right here, it was frowned upon by the previous administration. The previous administration, they made the cycle or the process of doing a bank M&A deal, it went from just usually about a year to a year and a half to like almost 2.5, 3 years, and that's just too long. You can't try to put a bank M&A deal together and have it last almost 3 years. I mean, it's just impossible for any deal to go through successfully. I mean, it takes 3 years just to recoup the money that you spent, and hopefully begin to recognize a profit off of what you spent on that bank merger. You can't wait 3 years just to complete the merger. So again, and then I got one more article on a blog post to share on this particular thing. So this is enormous. Community banks to save time, money from FDIC asset threshold and branch proposals. So community banks' growth will be less restricted under two recent proposals from the Federal Deposit Insurance Corporation. Under two recent proposals from the FDIC unveiled on July 15th, community banks will have more runway for asset and branch footprint growth as the proposed changes remove regulatory hurdles and reduce costs. There is a trend line that runs through all of these proposals. Cliff Stanford, partner at Alston and Bird LLP, advised banks and more, said in an interview, it's a refresh and a change in approach where the agency has some ability to maneuver to remove regulatory burden. Now, you have these thresholds out there. So, and some of the big ones are 1 billion, 10 billion, 50 billion. So, and now what does that mean? What that means is if you're a $1 billion bank and you want to grow to 2 billion, you have to cross over that $1 billion threshold. Now, when you do that, you have to be prepared because you are going to incur a tremendous amount of new costs, regulation. You're going to have to hire more people. So it's not easy. Like, in other words, you can't just go to like 1 billion and $5. You really have to jump more to like 1.2 billion very quickly. And that's why a lot of banks, when they start to get up toward these thresholds, they will prefer to do a merger and acquisition. They'll prefer to basically say, okay, if we're approaching 1 billion, if we could buy another bank that's maybe 500 million and put us together, or maybe they find a bank that's 800 million, it gets into a little bit closer to like a merger of equals type situation, which I'm going to talk about here in a second. Then you become a 1.8 or $2 billion bank, and that helps you get over those regulatory hurdles, if you will, very quickly, which again is super important if you want to continue to run a bank efficiently and profitably. And so these thresholds become very important. So what they're talking about here in this article is basically saying, hey, we are going to push some of these thresholds back, and we're going to make it a lot easier for banks to grow. Like when you cross $1 billion, you're not going to have all these additional regulations and all this additional stuff that's going to jump on top of you here. So, but let's continue on this for just a second. So after going unchanged for nearly 30 years, various asset thresholds related to audits, internal controls, and audit committees are set to be raised. The proposal, which the FDIC estimates will impact about 1,500 community banks, has institutions like Bluffton, Ohio-based Citizens National Bank of Bluffton breathing a sigh of relief. Citizens National Bank of Bluffton surpassed $1 billion in assets in December of 2023, subjecting it to requirements under the FDIC Improvement Act. related to external audits and more. Though the bank, which has 1.07 billion in assets, prepared in advance, complying with the new regulatory requirements turned out to be more grueling than expected. President and CEO Eric Faulkner told Market Intelligence. We were well prepared, he said, and yet not only was the cost just extremely significant, but the stress and the additional workload on staff was more than I had anticipated. The regulatory requirement added more layers to the bank's internal processes and controls, requiring it to have another internal person and an external auditor check behind work already done by one person and checked by another, Faulkner said. So these processes weren't perfect, but they certainly weren't broken. And that kind of stress was very hard on the staff, he said, adding he could not overstate the impact of it on his bank, which has 165 employees. So under the proposal, the threshold for compliance with the FDICIA will be raised to $5 billion, which Faulkner called a massive deal. No longer having to bring in outside auditors will be a massive cost savings for the bank, Faulkner said. It would allow us some time to breathe and really focus on other things at the bank and make our efficiencies improve. So again, this is enormous. I can't explain how big of a change this is. I mean, again, these things have been in place for nearly 30 years, and now you're finally going to see some adjustments here. Going from 1 billion to 5 billion in that threshold is just amazing. You're going to begin to see a lot. So in other words, again, why does this matter so much? Well, another option, like if you were going to cross the $3 billion threshold, right? Another option would be you would have to sell your bank, or you might, the board might be sitting there going, man, like what this CEO just described here, what I just read to everybody, this is a massive undertaking, and a lot of boards out there and a lot of management teams would sit there and go, man, I don't know if we should do this, especially if they're getting up in age. If you got a CEO and a senior management team, they're all in their 60s. They might sit there and just throw in the towel. They might sit there, you know what? We'll sell the bank to somebody else. We'll let the next generation, handle it. And you see a lot of that now. I think this is just a huge, huge game changer. So now, banks can continue to grow and not incur all these additional costs. They won't have to face very difficult options like, oh man, we're going to have to go out and buy another bank, or we might have to sell ourselves. So I just think that this is a enormous game-changing proposal right here, and this is going to have just major implications. Like you said, this could affect up to 1,500 banks in the country. Right now there's probably about 4,500, 4,600 banks in the U.S. So you're talking about almost a third of all the banks out there in the country, which I just think is just fantastic. This is really going to be a game changer. Now, I did want to read one thing to everybody real quick. This is a blog post from Emily McCormick over at Bank Director, and she wrote this. This was on the MOE solution, so the merger of equals solution. So investors appear skeptical of the recently announced merger of equals between Nashville, Tennessee-based Pinnacle Financial Partners with $56 billion in assets and $61 billion Synovus Financial Corp, headquartered in Columbus, Georgia. The transaction was announced in the afternoon on July 24th. The next day, Pinnacle's stock dropped 12%, and Synovus' shares dropped 17% over 3 days after Bloomberg reported on July 22nd that the bank was in discussions for a potential deal. Mergers of equals are complicated compared to standard M&A transactions and present significant execution risk. They involve people and computer systems and different protocols, says Jeff Davis, a managing director in the financial institutions group at Mercer Capital. That can make it tricky to achieve promised targets. It could be 2027 or even 2028 before investors know if the Pinnacle Synovus integration has borne fruit, he said. So that gets back to what I was basically talking about a few minutes ago there, when I basically said that, the timing of these merger transactions can be very tricky, that it could take a couple years before if this was successful. And if you have to wait, 2-3 years just to get a deal done, that killed. I mean, it just killed tons of deals. It just killed appetite for the whole M&A market. And as we've saw, I've done, market M&A update episodes in the past where I've shown just a lot of different stuff and talked about, just given a lot of the M&A numbers, talked about what's happening in the market, this and everything. So I was hopeful earlier this year, if you go back to January, I was hopeful that, the M&A market was going to be healthier this year. It was going to really pick up. It got off to kind of a sluggish start, but now we're really starting to see things progress. But the increase in M&A is also going to bring other, questions. Like I said, with the with the credit unions buying banks, that's going to become a hot button topic that obviously is just more of those transactions get announced. There's going to be more and more discussion around it. But that's like I said. So wanted to bring that in. So again, largest bank M&A deal year to date just announced with Prosperity Bank buying American Bank. So again, good news as the M&A market really starts to pick up and we really start to see some traction there. So good news with all of that. So, okay. Now let's get into some of the other big topics, other big things for the week here. I was not going to forget about my buddy Martin here. Martin got himself in a lot of trouble last year, and it's coming back again. He might have thought he escaped it, but nah. So Martin Grunberg, who ran the FDIC, so he was just named in an FDIC workplace misconduct report. So 4 other ex-FDIC officials were not identified in the Office of the Inspector General's findings, which followed a November 2023 Wall Street Journal expose of the allegedly toxic culture. And it was not a little toxic. It was majorly toxic. And what I had said at the time when this came out was this guy and his whole executive staff should have been canned immediately. But because of politics, because he was a Democrat in a Democrat administration, he was left there because heaven forbid if a Republican got put in there to run the FDIC. Not that really would have made much difference, but again, they allowed this guy who oversaw this insanely toxic environment at the FDIC to just hang out for another year and a half while all this was going on. And now he's named in this workplace misconduct report. So 5 Federal Deposit Insurance Corp officials, including then Chair Martin Grunberg, engaged in workplace misconduct, according to a report by the Office of the Inspector General released Thursday. While the scope and severity of conduct varied, our investigations developed evidence supporting that each of the senior officials personally engaged in some degree of inappropriate workplace conduct, according to the report. The report identified Grunberg, but left officials 1 through 4 anonymous. In its previous report, the OIG found that FDIC employees perceived that management was not effective in supporting victims of workplace harassment. Our investigations developed evidence supporting that certain actions of these senior officials did not protect victims of harassment, nor consistently align with the FDIC's applicable policies and stated core values, including accountability, fairness, and integrity, the OIG said. The findings came from the second part of a 2-part report on the FDIC's workplace culture, which followed a November 2023 Wall Street Journal expose alleging a boys' club environment that alienated women. According to the report, Grunberg could be short-tempered, was not always nice. His behavior could feel threatening, and he made people cry, an allegation the OIG heard from at least 4 people. The report also stated that Grunberg saw the Wall Street Journal expose and subsequent articles as a political attack rather than focusing on the underlying issues the article described, and that he seemed more interested in protecting himself than fixing the problems noted in the articles. Additionally, 2 senior officials alleged that Grunberg excluded them from projects and meetings that they would normally have been invited to given their responsibilities, and one of those officials believed they were excluded because they disagreed with Grunberg about the Wall Street Journal report. So again, I hope Martin, again, you have to say allegedly, he's allegedly, because again, has it been everything, but yeah, I hope that Martin is brought to answer for this, even if it's just being brought in. I don't know if he's brought in front of Congress to answer questions on this, to get hammered for an afternoon. I would settle for that. I would be happy with that, because this guy is I think this guy's a first-class clown. and he should have been fired immediately. And the fact that they let this guy hang around for a year and a half after this was exposed was just completely egregious. And it's something that, again, I had been reporting on for the last year since the scandal broke, and it's just terrible. It sticks in my craw, and I just So anyway, all right, enough on good old Marty there. Let's get to some other stuff. So big news over the last week. Obviously, one of the Fed governors shockingly resigned. So now there is a board seat there that the president of the United States has the ability to fill. So President Trump this week named Stephen Miran to fill the vacant seat on the Federal Reserve Board. Miran currently serves as the chairman on the Council of Economic Advisors in the Trump administration. So President Donald Trump has announced the appointment of Stephen Miran, chairman of the Council of Economic Advisors, to fill the recently vacated seat on the Federal Reserve Board of Governors. The appointment, announced in an August 7th post on True Social, comes after Fed Governor Adriana Kugler submitted her resignation earlier this month. Miran will serve in a temporary capacity until January 31st, 2026, as the administration searches for a permanent nominee. Stephen has a PhD in economics from Harvard University and served with distinction in the first Trump administration. He has been with me from the beginning of my second term, and his expertise in the world of economics is unparalleled. He will do an outstanding job. Congratulations, Stephen, as President Trump stated in his True Social post. Miran, who served as a senior advisor at the Treasury Department during Trump's first term, has emerged as a vocal critic of the Fed's current leadership. Like Trump, he has said that the central bank has kept interest rates too high despite inflation falling near the Fed's 2% target. In particular, he has questioned the timing and motives behind a major rate cut in September 2024, just weeks before the presidential election. So, again, this is big news because you now have another voice sitting there on the Fed Board of Governors. And now, so you've already got Waller and Michelle Bickey Bowman with dissenting votes at the last meeting. So now you got Stephen in there. So this is undoubtedly going to be a third vote sitting there. So now, the votes are starting to pile up against Jeremy Powell. And it's going to, this is a major sea change here. Because basically these three are now going to be able to put a lot of pressure on Jeremy Powell. But as we shall see in a minute in some of the other articles I'm about to show you, the winds of change at the Fed may already be taking effect. So it may not be that big of a deal at the end of the day. But I think the ability of Jeremy Powell to basically, as he has been doing all year with his, I'm taking my ball and going home, he's not going to be able to do that. That's just not going to happen now. There's going to be too much pressure, too many dissenting opinions there for him to just simply brush it off and just act like, nothing's happening, nothing to see here, as he has been. So, all right, let's look at some other things here. So this was a fascinating situation this week. So Trump calls for Intel CEO to resign amid concerns over Chinese ties. So the president's demand follows a national security warning from Senator Tom Cotton about the Intel CEO's links to firms tied to China's military. President Donald Trump on August 7th called for the immediate resignation of Intel CEO Lip-Bu Tan, echoing growing Republican concerns about the executive's alleged ties to Chinese firms linked to the People's Liberation Army, the military wing of the Chinese Communist Party. The CEO of Intel is highly conflicted and must resign immediately, Trump wrote on an August 7th post on True Social. There is no other solution to this problem. Thank you for your attention to this matter. Intel headquarters in Santa Clara, California, plays a critical role in U.S. economic and national security policy as a leading manufacturer of cutting-edge chips used in defense systems, data centers, and artificial intelligence. Again, this is a fascinating story, because, this is just highly unusual. When is the last time a president of the United States has ever come out and demanded the immediate resignation of a major CEO from a major corporation? And obviously, he had to have had good reason for this. Like, there had to have been, this guy has been, my understanding is that this guy has been very open about his ownership in these companies and his ties to China. So it's not like this is a big secret. And obviously, people in the intelligence community and other people, obviously raised a major red flag over this gentleman and put it up to as far. I mean, it had to go to the president. I mean, what does that tell you? So, but let's see this here. So, because this came out this afternoon, Intel CEO responds to misinformation and Trump threat in a letter to employees. So Intel CEO Lip Bhutan said in a memo to employees that he always operated within the highest legal and ethical standards, whatever that means. The memo comes after President Donald Trump called on him to step down immediately. The resignation demands also coincided with questions from Senator Tom Cotton over Tan's connection to Chinese companies and the potential security ramifications. So this guy basically writes a letter, and let's read what he wrote here, because this is fantastic. I want to be absolutely clear. I just can't. I mean, this guy's the CEO of Intel. He's supposed to be the CEO of a company. He doesn't have a head of marketing. The head of marketing wasn't there to tell this guy that, like, you don't start by saying, I want to be absolutely clear, that means you're lying when you say that. He hasn't learned from all of the politicians. Whenever you hear a politician come out and say, let me be absolutely clear, they're lying. So that's how he starts. Like, what? All right. So I want to be absolutely clear. Over 40 plus years in the industry, I built relationships around the world. Therefore he's not denying any of this, and across our diverse ecosystem, again, whatever that means. And I have always operated within the highest legal and ethical standards, according to who? He wrote in a memo to employees on Thursday. Tan said that Intel is working with the White House to address the situation. How is that? Shouldn't that mean that if he's the guy that's been called out, shouldn't he be either showing up himself personally to the White House to go have a conversation? And that he supports the president's dedication to advancing U.S. national and economic security, and said Intel's board is fully supportive of the company's transformational plan. Tensions hit a boiling point Thursday, obviously, when Trump called for his immediate resignation. Trump's demand coincided with questions from Senator Tom Cotton over the CEO's connection to Chinese companies and the potential ramifications for U.S. security. Intel is required to be a responsible steward of American taxpayer dollars and to comply with applicable security regulations, Cotton wrote. Mr. Tan's associations raised questions about Intel's ability to fulfill these obligations. In his letter, Cotton also highlighted a criminal case at Cadence Design Systems involving illegally shipping products to China, and asked whether Intel made Tan liquidate investments in chip makers tied to the Chinese Communist Party. Tan worked at Cadence for more than a decade and served as the CEO. Tan was appointed CEO of Intel in March, succeeding Pat Gesslinger, who was ousted by the board in December after struggling to turn around the embattled chipmaker. Bernstein analyst Stacey Ragson said in a note Thursday that the firm does not believe that Tan is conflicted, but his connections to China, again, no denial there, depict an increasingly bad look. You might say that. Considering who's currently in the White House. Oh, well, again, this isn't a Donald Trump problem. This is the CEO of Intel having, ties to companies that he shouldn't have problem. So this will be interesting to see where this goes. I mean, obviously, this is an incredibly weak response on the part of this CEO of Intel here. An incredibly weak response. I mean, to put out a statement where you lead off with, I want to be absolutely clear. Let me be absolutely clear. Let me be clear that I'm completely lying through my teeth. Doesn't deny that he, owns stock or has relations with these companies, doesn't say that, there's a chance I might be conflicted here, or I could see how this may look badly. And again, he's operated with the highest legal and ethical standards. Well, what is that? Because, China, their idea of ethics is very different than ours. It's perfectly legal, and it's a common practice of Chinese businessmen to basically bribe people all over the world. You can't bribe people in China, but you're free to bribe whoever you want around the world, and that's exactly how they operate. Is that would we consider? Do we here in America consider that ethical standards and ethical business practices? No, no, we absolutely do not. But so I asked the question: whose legal and ethical standards is this gentleman complying with? The U.S. or with China's? So again, very interesting situation. It'll be interesting to see what this guy does. It'll be interesting to see what this guy ultimately does and what the Trump administration does in response. Like, will they press if this guy doesn't want to go, will they press the issue? Will they press Intel? Will they press the board? Will Trump continue to hammer this guy on social media? I don't know. We'll wait and see what happens. But like I said, thought it was a fascinating story and wanted to bring that out to everybody just to let everybody know what was going on with that. So, okay. Another big news of the week here. Trump targets politicized debanking in new executive order. So the new order requires regulators to investigate whether banks have engaged in politicized or unlawful debanking and to issue penalties. So President Donald Trump signed an executive order on August 7th to stop banks from denying people financial services because of their political or religious beliefs, a practice known as debanking. According to a White House fact sheet, the executive order requires federal banking regulators to investigate whether banks have engaged in politicized or unlawful debanking and to issue penalties such as fines or consent decrees. The order also directs regulators to remove terms such as reputational risk from their guidance, language that has allegedly been used to justify debanking. Yes, we're going to get to this in just a second. Trump first announced his plan on August 5th, stating in an interview with CNBC Squawk Box that banks and regulators have been involved in alleged discrimination against conservatives, including himself. During the interview, Trump accused two major banks, JP Morgan Chase and Bank of America, of denying financial services to his business after the 2020 election. He said the same treatment has been given to many conservatives, particularly his supporters. The order requires federal banking regulators to review complaints for cases of unlawful debanking based on religious and report them to the Attorney General. In addition, the order directs the Small Business Administration to ask all banks under its oversight to try to reinstate individuals or entities previously denied financial services. The order also asks the Secretary of the Treasury and the President's economic advisor to create a comprehensive plan to fight politicized or unlawful debanking. This could include suggesting new laws or regulations. According to the White House, there are numerous examples of politicized debanking. In one case it cited, a major bank allegedly refused to process ticket payments for a Republican event, only reversing the decision after its action gained public attention. Federal regulators have also allegedly encouraged banks to flag individuals for transactions with companies such as Bass Pro Shop or Cabela's, or for using terms such as Trump and MAGA in peer-to-peer payments, even without any evidence of criminal activity, according to the White House. So this is a very interesting one here. And so how are banks going to react to this? Well, I already saw one thing earlier today in the reaction here, and that is banks are going to say that during the last administration, one of the things that they were evaluated on was reputational risk. And under that category of reputational risk, they had these rankings. And basically one of the rankings was, certain clients were deemed as high risk, meaning that, and if you had X number of these high risk clients, you were going to have to do certain things. You're going to have to, take different measures with capital, liquidity, other stuff like that. So it's basically like the bank is being penalized for having these customers, very similar to, if you guys remember, Operation Choke Point, where President Obama and the Obama administration basically tried to a backdoor basically putting out of business of gun retailers around the country because they basically, were anti-Second Amendment and didn't like guns. So they tried to use Operation Choke Point to basically make any retail gun store in the United States considered a high risk. And basically, once they're labeled high risk, pretty much any bank out there is going to go, we don't want you as a client. You're going to have to go. So the bank's excuse here being is going to be one of, hey, we didn't necessarily want to do this. We were forced to do this through regulatory action. And you could understand where they're coming from there. Like, yeah, okay, but for them to flat out deny that, like, oh, well, we weren't doing any of this. It's like, no, you did it. You knew you did it. You knew what you were doing. There are literally dozens of examples of this. I could go, we could spend hours literally talking about all these examples of things that I've seen over the last, 3-4 years. The problem is, what are you going to do about it now? Like, what happens now? What can really be done now? I mean, if somebody got debanked and they got kicked out of their bank 3 years ago, they've probably set up shop at another bank. They're probably, again, they're probably doing fine. They probably got back to normal. Are they going to want to go back to the bank that kicked them out? I seriously doubt it. I seriously doubt they'd ever want to do business with them ever again. I don't know, maybe it could be some point of pride or something, or you feel like you got back at them by going back and saying, nah, you had to open my account. I don't know, something childish and stupid. But, it's like I said, I just, and then the question is, well, how does this stop things going forward? Again, they were already, the administration was already asking regulators to get rid of the reputational risk as a one of the standard by which banks were reviewed in stress tests and other things. So that category was already getting taken out of the mix, which basically would stop the quote unquote potential for, from a regulatory perspective of forcing a bank to debank or kick somebody out because they were labeled as high risk. So, you've already kind of taken that out of the equation. And I don't think that banks under this administration in this current environment, I don't think, obviously they're not doing that stuff right now. And if I don't know, if Trump leaves the White House in a couple of years and we have a new election in 2028 for a new president, we get a Democratic president, a Democratic administration that comes in, they could go literally right back unless there's some law passed. I mean, they could just go right back to this and just say, hey, we're putting reputational risk right back in. We're going to basically go right back to this. And and again, they'll run under the cover of, this isn't debanking. It's regulation. Oh, we're telling the banks that, you can't have these type of customers because they're high risk. And they could cause you reputational harm. So again, there's a lot of gray waters with this, a lot of very muddy gray waters with this. And it'll be interesting to see, like, do they go back and actually do an investigation, and do they try to, maybe try some kind of like clawback or something like that? Like, if they find after some type of formal review or some type of report or something like that, an investigation that like, say JP Morgan did in fact kick a bunch of people out that they shouldn't have kicked out, do they get penalized? Like, what does that look like? How does that work? So again, I'm not really sure what happens with this. Again, I think it's a good thing. I have seen this politicization, if you will, of this kind of weaponization of the banking system against people. And I think it's a horrible, disgusting thing when it happens, and nobody should be doing it. Either side of the aisle, this stuff should just not happen. But like I said, I think it's a good step. What ultimately comes of it, I don't know, because like I said, I think it's again, banks could say that, oh, we were just following orders. This is a regulatory issue. So a lot of stuff can come out of this that is not clear, so to speak. So, all right, let's keep rolling here. So another thing. So Trump shakes up Wall Street with orders on 401ks and debanking, but the executive orders give Wall Street one change it craved and another it feared. So the one here I want to talk about here is the 401ks. And I actually just did an episode this week on this change coming to 401ks. So The move fulfills a long sought goal of Wall Street hedge funds and private equity firms, which for years have wanted to tap into the giant pool of money in 401ks and other defined contributions plans. It's a critical step in starting the ball down the track, said Mark Lipschultz, co-CEO of Blue Owl Capital, and is working on offerings that incorporate private markets into all-in-one funds known as target date funds. He said the federal regulators tasked with executing the orders should be thoughtful and methodical about opening up access to private investments. It is a different story for big banks. And then we get back into the kind of discrimination thing, but let's go to the 401k plans here. So it remains to be seen whether the order on retirement plans will encourage employers to offer 401k options with private assets, which tend to be harder to buy and sell than other investments and typically come with higher fees. Firms that invest in private markets say those fees are justified by the potential for higher returns, but employers have been sued over fees in the past. The risk of such litigation has prevented many from adding private market offerings to their plans. Mark Pinto, global head of private credit at Moody's, cautioned the investment firms could also be exposed to new risks by opening themselves up to 401k money. If these new investments don't live up to their promise, asset managers could face lawsuits and regulatory heat, he said. Pension plans have long invested in private markets, relying on the promise of higher returns to help meet their obligations. But Wall Street firms are looking for new sources of growth, in part because many private sector employees have replaced pension plans with 401ks. I really think of it as putting people back to where they were 30 years ago in terms of having your retirement funded by the growth of the U.S. economy. The executive order directs the Labor Department to consult with other federal agencies to determine what regulatory changes are needed to ease private market access to 401ks. So this is an enormous change here that we could be seeing to 401k plans. Now, what does this mean? This really gets into the world of what's called alternative investments, meaning hedge funds, private equity. Like, what are some of the things that they offer? Well, you could get access to IPOs. That could be a great one. PPMs, private placement memorandums, which are real estate, offerings for real estate investments. Different startups, different types of capital stacks, different types of things. There are a lot of investments there now, but here becomes the issue, and this is what I talked about in the episode that I did this week on the 401ks, is that the problem is that if you get a mass market audience, right? Like say you have I don't know, 50 million people all of a sudden decide to jump into this one private equity fund. There's a chance that could, in a certain respect, in a way, overload the fund. And then when, because again, the retail investor, if you will, is much more prone to, panic selling. If something happens in the market, they're going to try to sell it at things quickly. And the problem is a lot of these private equity or hedge fund type funds or products, they are not designed they're not designed to be sold like stocks or mutual funds or equity or ETFs. Like, they don't work like that. So, some of these things have very detailed, you might only be able to sell out of it on a quarterly basis or once a year or things like that. There are a lot of potential problems here. And that doesn't even include the overall risk. Again, classic economics 101, risk and return. The greater return, the greater risk that you're taking on. If you want to get 20, 25% returns, that's great. You're also going to take on a lot more risk in trying to chase those larger returns. How many people will have the stomach for that? If, in other words, what if you invest your money, right? Say you've got your 401k plan and you're like, you know what, I'm going to put 20% into private equity here and I'm going to invest in this particular fund. And again, say the overall market is doing fine, but something happens with that particular fund. Maybe it's invested in a specific kind of industry, and all of a sudden, something blows up and now you have this massive sell-off. That thing is in the toilet, and and that causes your 401k to drop 20%. Meanwhile, the overall market is maybe not lighting the world on fire, but maybe it's returning 5%, 8% for the year or something like that. It's just having a decent year. So you could be in a much less risky product with getting a stable return, as opposed to being something very risky that could blow up in your face majorly. So again, it raises a lot of very interesting questions as to what's going to happen here and how this is going to play out. And again, I have very conflicting opinions on this, because on the one hand, I think it should be open to people. I think people should have the ability to get into, again, so the SEC creates a category called an accredited investor. And a lot of people are locked out from the best investments because because you don't meet the definition of being an accredited investor. Like, in other words, if I have an IPO, securities law dictates that when I'm out there selling for the IPO, I can only sell to people that are defined as accredited investors. And you have to prove that they are accredited investors, because if you ever get like an audit or a review and the SEC comes in and says, hey, listen, do you remember a year ago when you did your IPO and you guys sold all that stock? Yeah, we want to see who you sold it to. We want to make sure that you followed Regulation D and that you did all the proper stuff, and that basically you didn't sell to a bunch of people that shouldn't have been in there and shouldn't have got the stock. And so again, you have to get financial documents from potential investors to basically to prove to you that they're an accredited investor, and then they are allowed to, then you have to present them with a prospectus. You got to give them the whole dog and pony show. You got to give them, give them the speech and everything. Then they are an informed investor now, and they can make their own decision. So. But again, because of that, a lot of people are locked out of the best investments, and it stinks. So again, there's a part of me that goes, I don't like people being locked out of the best investments. I think that if you have a risk appetite for that and you want to go do it, hey man, it's your money, go do it. On the other hand, I also understand that there are a lot of people out there that are not what I would describe as sophisticated investors. There's a lot of elderly people that may not, like maybe, when you were 60, you were sharp as a tack and you knew what was going on. Maybe now you're 85 and, you're slipping a little bit and you're just not as, you're not maybe as up with things as you once were. And you might be looking at stuff and going and just, oh, hey, that looks good. Yeah, let's do that, and then it blows up on you. So, again, or maybe you might just be 25 years old. Maybe your degree isn't in finance or economics, and maybe you just don't understand investments that well. And you just looking at your 401k, a company says, oh yeah, here's your different investing options. And you're just like, oh, this looks good. Let me do that one. And you click on it and it's in your portfolio, and that's that. And it's usually as simple as that. But again, so again, it's like, I want people to have access to it, but I'm also leery because I think a lot of people could get in trouble with it because they wouldn't like fully understand the risks and really understand the investment product that they're getting into. And that, again, if it goes fine, then hey, it's all great, right? But it's if it goes bad, if it goes bad, it can hurt you in a massive way. So that's all. So again, really interesting stuff there with the 401k. We'll see what happens there. Okay. Other big news: Trump fired last week the head of the BLS, the Bureau of Labor Statistics. Got a couple articles here on that. So Trump's BLS firing tests Wall Street's reliance on government data. Some fear a decline in the world-leading economic statistics underpinning U.S. markets. Now, I wanted to share this article with everybody for a very specific reason, because this is a perfect example of what I call gaslighting BS. they had no problem, last year when the BLS reported over 1 million jobs that never existed. Okay. They totally fabricated over 1 million jobs, 1 million jobs. And they had no problem with that. There was no discussion. Nobody had nothing. They had nothing to say about that. CNBC wouldn't talk about it. Bloomberg wouldn't talk about it. Nobody would mention it. Nobody would talk about it. And there have been problems over there at the BLS with their numbers for years. I think you could take the L out of there and they could just be the Department of BS, because that's what they have been spouting out. I think the only thing that's shocking in this whole instance is the fact that the woman who was serving as the head of the BLS made it 6 months into the Trump administration. I think she should have been canned on day one, given the track record of what was going on over there. But it is rich. It is really rich for, Wall Street and the business media to put this out and basically say like, oh, that now all of a sudden there's this, because Trump fired her, there's this massive fear of, we can't believe, we may not be able to believe the underlying numbers. It's like, shut up, man. Really? Shut up. It's like, just stop. It's I'm tired of the fear mongering nonsense. And then let's go into this article here. So, jobs report agency faces scrutiny after Trump fires its chief. What to know? So, understanding how the Bureau of Labor Statistics recorded one of its largest jobs data revision in decades. The Bureau of Labor Statistics has come under scrutiny since President Trump called its July jobs report rigged and fired its commissioner, Erica McIntarfer. In my opinion, today's jobs numbers were rigged in order to make the Republicans and me look bad, Trump wrote in an August 1st post on True Social. Now, to be fair, I think that's taking it a little much. I think that the labor market has been slowing down in the last few months. I think the numbers are bearing that. The problem lies in the fact that this restatement of numbers was massive. It was a massive restatement right here. Last month, the U.S. economy created 73,000 new jobs, below the consensus estimate of 115,000. Additionally, the Bureau revised down its May and June readings by a combined 258,000 jobs. That's 250,000 jobs, the largest 2-month revision since 1979 outside the pandemic period. While its data collection efforts were criticized during the previous administration, Trump's latest complaints have placed a renewed focus on the federal agency's statistical gathering methods. So, and then it goes into, what is the Bureau of Labor Statistics? It was founded in 1884. The Bureau of Labor Statistics functions as an independent source of economic data under the Department of Labor. The agency is overseen by the Labor Secretary, but managed day to day by a Senate confirmed commissioner. Today, the approximately 2,300 person Bureau gathers data and publishes reports on crucial economic issues, including payrolls, unemployment, wages, productivity, and inflation. Now, I will say this. One of the things I heard Bloomberg and stuff crying about this week, Fox Business, everything, sitting there going like, oh, well, the government, Wall Street, we depend on these numbers. These numbers have to be accurate. And I was trying to go back and find the clip of when I did this show last year. I want to say it was maybe November of last year. I had an episode where I literally ranted for about 5 or 6 minutes, basically saying that exact thing when we got the 800,000 plus job revision, the restatement, where it basically came out that it said, oh, there was over 800,000 jobs that were fake. I went on a rant basically saying, how could they do this? How could they put this out? Everybody depends on these numbers. Like, how are businesses supposed to make decisions if these numbers cannot be trusted, or if these numbers are a hot mess? So, and I tried to go find it, but I couldn't find it. I didn't have time, but I would have loved to have found that and played that for everybody, just so everybody could see that was exactly what I was talking about over, or about, a year ago. And now here we are today. And my problem with it is that, why weren't they saying this a year ago when I was talking about the same thing? Why weren't they saying the same thing? Where was this outrage, a year ago or 2 years ago, or, as I've been reporting for many months now on how all these job numbers didn't make sense. I've done numerous episodes on the job reports over the last year that have come out, and the constant restatements. You get a job report comes out, and we created 220,000 jobs this month, and everybody goes, oh, that's great. And then the next month, here comes the revision. Oh, it wasn't 220. It was only 115. It's like, wait a minute, what? Like what's and you're just seeing this just constant restatement. So now, what's going on here again? What they talk about in this article is how that the process of how they collect, disseminate, and present a lot of these numbers, a lot of this information is now coming under a lot of scrutiny, as it should, because the next person who comes in here has to get this sorted out. They've got to get this corrected. They've got to start reporting numbers. You can't. Seriously. There over 1 million jobs last year didn't exist. We just got a restatement of over 250,000 jobs that apparently didn't exist. Seriously, who's counting jobs over there? Does nobody know how to count? I'm sorry. I must have missed something here. I thought that if you were going to work for the Bureau of Labor Statistics, you might have to be good at math. I would thought that would have been a kind of an obvious prerequisite for the job. So we'll see what happens with this. But like I said, I was upset about the faux outrage. Like, oh, how could he do this? How could this happen? And, oh, how can we trust the numbers now? Oh, how can we trust what's going on there now? Because this is all political. Like no, it is political, because the BLS made it political, by playing games with the numbers and continuing to play games with the numbers for years, not a quarter, not a month. This has been going on for years. Believe that. It's years this has been going on. And, it's been an embarrassment. And I think that, again, the corporate business media should be embarrassed about the way that they have reported on this story, because it's an absolute joke. So anyway, all right, I'll get off my soapbox there on that one. Okay, let's talk about a couple of the what's going on with some of the economic indicators here, and then I want to talk about potential Fed rate cuts for a second, and then I'm going to get into what the episodes were that I put out for this week, economic indicators that we got coming up for this week. But let's go through a couple of these articles here real quick. So unemployment claims rise for the second straight week as labor market cools. So recurrent claims continue to rise, also reflecting challenges for job hunters. So the number of workers filing new applications for unemployment benefits rose for the second straight week as a fresh data point to a cooling U.S. labor market. According to the Department of Labor, initial jobless claims increased by 7,000 to 226,000 for the week ending August 2nd from the previous week's upwardly adjusted 219,000. The weekly claims figure released on August 7th came in higher than economists' expectations of 221,000. The 4-week average, which strips out week-to-week volatility, dipped to 220,000 from 221,250. Initial claims filed in a program for federal workers also fell by 14 to 708 in the week ending on July 26th, the department reported. So we now have this kind of increase in unemployment claims. So what are going here? So now unemployed Americans endure longer job searches in a cooling market. So the number of people unemployed for at least 27 weeks tops 1.8 million. I'm considering myself semi-retired at this point, was a comment from one of the people. More than 1.8 million people have been unemployed for at least 27 weeks, the highest level since 2017, excluding the pandemic, Labor Department's data shows. So job seekers are out in the cold this summer, especially the ones who have been hunting for a while. So beyond the headline-grabbing top-line numbers in the jobs report for July was another striking piece of data. The number of people unemployed for at least 27 weeks topped 1.8 million, the highest level since 2017. Not counting the pandemic's unemployment surge, the median length of unemployment in the U.S. has also ticked up from a seasonally adjusted 9.5 weeks in July of 2024 to 10.2 weeks last month. So this job hunting struggle highlights a significant undercurrent in a labor market jolted by tariff uncertainty and cautious businesses. The latest numbers show job growth has been sluggish for months, while the unemployment rate at 4.2% remains low by historical standards. Companies aren't hiring much. Now, let me ask everyone a very interesting question here. Let's see if anybody wants to comment on this one. So, what happens at 27 weeks? 27 weeks, as everybody might realize, is over half the year. 52 weeks in a year. 26 weeks is half the time. So once you go over 26 weeks, you then fall off of what? Oh, that's right, the unemployment report. Why is the unemployment rate at 4.2%? Well, because those people out there at 27 weeks that are still looking for a job, they don't count in that number any longer. The unemployment report has a couple different numbers. You have the U6 and the U5, U4, U5, U3. The unemployment rate at 4.2 is the U3 rate. That's the rate that the press always uses. The far more accurate rate is the U6. The U6 includes all of these people that are still looking for jobs after 27 weeks and a whole bunch of other people with part-time jobs that want full-time jobs but can't get them. And the U6 is much, much higher. The U6 is sitting around 7% right now, which is a much more accurate rate of where the unemployment is. And again, I've talked about a lot of this stuff in the past. But again, here you see this chart here. We've got, number of people unemployed for at least 27 weeks. You can see this starting to creep up. It's now sitting at 1.8 million, which is the highest it's been in a few years. So, but again, it's just the overall picture. So, right. So we're seeing here that, unemployment claims are starting to rise a little bit. People that are unemployed it's taking them a little bit longer to find a job, right? So again, we're seeing this weakening of the labor market. Now, isn't it great that our central bank, with the labor market weakened, that they came to our rescue and reduced rates? Oh, no, that's the Bank of England reducing rates again. Yeah. Our central bank, they hate us. Jeremy Powell hates us. So Bank of England narrowly votes to cut interest rates to 4% as balancing act continues. So 9-member MPC voted by a majority of 5-4 to reduce the key interest rate, the bank rate, by 25 basis points rather than keeping it on hold. The voting is a reflection of the finely balanced situation the PMC currently faces in terms of the factors driving monetary policy, according to the Bank of England Governor Andrew Bailey. George Brown, senior economist at Schroders, said the latest rate cut, not one, it's the latest, was no surprise, but said the path forward is anything but clear. Now, this was already done after they had already cut their rate 3-4 times. A number of successive 25 basis point rate cuts that has taken them down to the 4.25. They took them down from 4.25 to 4% on Thursday. Now, Bank of England, they've got no problem cutting the rate. As a matter of fact, the latest rate cut was no surprise at all. But our guys, no rate cuts for us. Every central bank around the world is cutting rates, but not ours. Ours, nothing there. So, but maybe we can hope. So Fed officials signal possible interest rate cut. Is this the right time? So a weekly jobs report has more Federal Reserve officials saying the time might be right for interest rate cuts. Minneapolis Fed President Neil Kashkari said data suggested the economy is slowing and that the Fed may need to act in the near term, which could be as soon as its September meeting. While officials are still keeping an eye on inflation, San Francisco Fed President Mary Daly said the risks of quick decline in the labor market mean that the Fed should act soon. So as inflation remains stubborn and concerns about the labor market rise, several Federal Reserve officials are now saying that the interest rate cuts may be imminent. That's a change in tone from last week when most Fed policymakers voted to leave their influential interest rate unchanged for the fifth time this year. Fed officials had been content to wait and see how tariffs were moving through the economy, but the July jobs report raised concerns that the economy wasn't as strong as previously thought. In a series of public remarks this week, Fed officials said the weakening in the labor market could prompt them to cut interest rates sooner rather than later. So wage growth is coming down. We've seen the job numbers and consumer spending is cooling. All that suggests the real underlying economy is slowing, said Minneapolis Fed President Neil Kashkari in a CNBC interview. That means in the near term, it may become appropriate to start adjusting the federal funds rate. So Kashkari is now officially signaling to everybody that he is on the fence and he is now willing to very much consider cutting the rate. So you put that now with the appointment that Trump is going to put in there. You put that with Waller. You put that with Michelle Mickey Bowman. Now you're up to 4 people now. They're basically saying, hey, we're willing to cut rates. So the thing there with that is that, Powell can't afford too many more dissenters. I mean, they were already almost at least from what people were saying was going on internally, they were already at a spot where about half the votes on the FOMC were basically, leaning toward the rate cuts. Now, you're beginning to see a tipping moment here where pretty soon this is, Powell, whether Powell wants to or not, he's basically going to be forced by the rest of the people there on the board with him to basically cut the rates. So we will have to see what happens there. Again, would I be shocked if a interest rate cut does not occur in September? No, I would not. Would I be shocked if there's no interest rate cut in October? Yes, I would be. I think that September might prove to be Jeremy Powell's last stand. I think that if he comes out and basically decides that he's going to be defiant and he's not going to cut the rates, and we continue to see a weakening of the jobs market, because here's the other thing. Say we get a new head of the BLS and that new head goes in there and starts cleaning house and says, you know what, we're going to have this major, we got more jobs that didn't exist that need to come off the numbers. And so we're going to put out this big revision to clean the numbers up. And obviously that big revision makes the job market look even weaker. What's that going to do? Obviously that's going to put, tremendous pressure at that point. So again, you could have some interesting things happen here in the next couple of months that basically change the game. So, but right now I would put odds, if I was a betting person, I would put odds probably about 50-50 on a September rate cut right now. I think that odds should be much higher. I believe the remaining FOMC meetings for the year are October and November. I don't think that there is a December meeting this year. Usually, what the Fed always does is they have no meeting in August. They always take the month of August off. And then when they come back for the fall in September, October, November, December, there's always 3 meetings in those 4 months. November, December, because the holidays and stuff, where the holidays fall, they usually only have 1 meeting that covers kind of November and December. It's good, as they say, it's good to be the king. It's good to be the king, right? You get, we're going to do our meeting real quick, and then we're going to get out of here for a month and a half, and we'll come back at the end of January and let you know what's going on. It's a great job. Best job in the world, right? Sorry, I digress there for a moment. So they'll have 3 more meetings. So I think, like I said, I believe this year it's September, October, November. Like I said, I think 50-50 right now in September. I think I would believe you're going to get rate cuts in October, November. And again, are they going to be big rate cuts? No, they're going to be quarter point rate cuts, but that's okay. That's okay. Bring it down at a quarter point at a time. But keep doing it, do it every meeting for 6 months, let's get down. And again, I don't think we need, President Trump has called for, he wants rates to come down 300 basis points. I would not I would not advise that. I would not advocate for that. I think the sweet spot is somewhere between 100 to 150 basis points. I think if you could get mortgage rates back down into the fives, 5.25, 5.5, I think that is perfect. I think that puts it that I think that will start the market humming again. That'll get people doing refinances, cash outs. It'll get people buying properties again. And I'm going to show you guys an article here in a little bit later. I actually have an article. Where would interest rates have to be to make housing affordable again? So hang out, wait about, like I said, we got to get through some other stuff first, but hang around for about a half hour and we'll get to that. We'll get to that article a little bit later. So there you go. So there would have it with the Fed. Now, all right, I'll come back to the tariff stuff here in a minute. I just want to, okay, this is the point in the program where I like to go through banking news. I like to give you guys the economic indicators of the week, and I like to talk about what episodes I put out this week. So what are the economic indicators we have coming up for this week? Well, on Tuesday, August 12th, we have the core CPI. We have the federal budget balance. We get the API weekly crude oil stock. On Thursday, August 14th, we get the continuing jobless claims, the core PPI, the initial jobless claims, the Fed's balance sheet. And then finally on Friday, August 15th, we get core retail sales, New York Empire State Manufacturing Index, industrial production, Michigan consumer sentiment, and the U.S. Baker Hughes total rig count. So those are our economic indicators for next week. So again, it's kind of interesting that it's coming out Tuesday, Thursday, Friday. Usually stuff's a little bit more spread out during the week, but obviously a lot of inflation numbers, core retail sales, people will really be keeping an eye on. Industrial production's a big one. The Michigan consumer sentiment. So we got some big key economic indicators coming out next week that people will obviously be paying a huge amount of attention to. So, okay. What episodes did I put out this week? So on Monday, I had episode 439 came out, which was called Big Changes Are Coming to Your 401k Plan, but Are They Good? And this was kind of what I talked about a little while ago. So this episode examined two articles from the Wall Street Journal titled Wall Street's Big Bad Idea for Your 401k and Retirement Account and Emergency Savings. 401ks increasingly play a dual role for many workers. So basically, there are big potential changes coming to the 401k. The question is, are they good changes? It becomes a bigger question when you examine how people are actually using their 401k plans. So again, if you have a retirement plan, you definitely want to go check that episode out. Then on Tuesday, I did episode 440, which was called Let's Talk About Generative Engine Optimization, or GEO. So this was a new term. I was not aware of generative engine optimization until I saw this a week ago, and I thought it was fascinating. So this episode examined a blog post from PCBB titled "Move Over SEO. GEO is the new sheriff in town." So everybody knows what search engine optimization, or SEO, is. That has been the dominant strategy for getting your bank, your business to the top of the list on Google search for years. As AI-backed internet searches continue to grow, a new strategy called generative engine optimization, or GEO, is emerging. So GEO is the next generation of SEO. Banks and businesses need to start thinking about how organic search activity may decline in the future and how to position themselves for AI search results. So again, fascinating article, really interesting stuff. I hope people go and check that out. As a matter of fact, I got a little test for you. Whatever AI you use, like whatever app you've downloaded to your phone, say you've downloaded Grunk or ChatGPT, or what's some of the other ones, like Gemini? Was it Perplexity? Is that one of the other ones? But all right. So say you're using ChatGPT. I want you to go onto ChatGPT and I want you to look up your company or your bank or your business or whoever you work for. Just do a search. Or search yourself. Like maybe you're a consultant, or an attorney, or an investment banker, or whatever. Search yourself. I think you will be fascinated to see what comes up, how fast it comes up. And I think you'll be really interested in terms of when it tells you at the end, like what sources it took or different things that it searched, the different things that came up. Like I said, I think you will find it very fascinating. So if you haven't done an AI search on yourself or your company, go do it, because I think you'll be fascinated by the results. And I think it'll give you a big indication of why this whole concept around GEO is going to become massively important in the years ahead with the what's called generative engine optimization. So go check that out. Okay. Then on Wednesday, I did episode 441, which was a review of ICBA's guide to the Genius Act. So obviously the Genius Act was stablecoin legislation that was just passed. So this episode reviews ICBA's, that is the Independent Community Bankers Association. They did basically a guide, not very long, about 8 pages, but did a beautiful job of writing up the Genius Act. This was a summary for community banks. The report includes the following topics, basically permitted payment issuers, composition of reserves, authorization for bank custody, application of AML, which is anti-money laundering, tailored capital, liquidity, and risk management rules, and timetable for implementation. So again, if you don't really know much about the Genius Act, if you're really curious about it, you want to learn some more about it, go watch that episode. I would also highly recommend watching the crypto series that I do. If you haven't checked out the crypto series, definitely want to check that out. Then on Thursday, I did episode 442, How Can Your Bank Build an AI Policy? So this episode examined an article from Independent Banker magazine titled How to Build an AI Policy at Your Community Bank. Does your bank have an AI policy now? Not sure where to start? Well, lucky for you, this article offers 4 steps your bank can follow to set up an AI policy. Number 1, figure out where AI is already being used in your bank. Number 2, set guidelines for bank employees' use of AI. Number 3, assess the customer impact of AI. And then number 4, ensure your plan evolves as AI does. But again, very interesting article. I think a lot of people would find some really good use in that. And then on Friday, earlier today, I had episode 443 come out, which was called It's Options Mania, Baby. This episode examined a blog post and an article from the Wall Street Journal. The blog post was titled Why Options Mania is a Contrarian Indicator. And the article was titled, Is this frothy market, in this frothy market, it's boom times for brokers like Robinhood. So options trading has exploded in the last 5 years due to going electronic and the innovation of products such as what's called 0-day to expiry contracts. Online brokerages like Robinhood are making enormous amounts of revenue off this trading. Is this a good thing for retail investors, though? So again, if you're interested in options, or again, might find that topic interesting, there's a great episode for you to go check out. So, okay. So those were my 5 episodes of the week. Now it's time to get to let's get to some bank news here for everybody. All right. First thing up, major news around open banking. If anybody doesn't know what open banking is, that is otherwise known as the 1033 rule that was put out by the Consumer Financial Protection Bureau. Now, I cannot stress enough, the open banking rule is just that. It's a rule. It is not a law. Congress did not pass it. There has never been discussion on it. The CFPB just put it out there and said, this is our rule on open banking. We're doing this and we're moving forward with it. And that's that. And nobody was really allowed to discuss it. It is shocking to me how many people are not aware of what this thing is, because this is a nightmare. It's a nightmare. Now, the CFPB, after, again, the shift over in the Trump administration, after the Trump administration has tried to dramatically shrink the CFPB. Well, the CFPB went to court and basically said, hey, we're basically going to kill our own rule. So things were looking real good. Then all of a sudden last week, Jamie Dimon basically came out and said, we decided that we're going to start charging for that data. You know, any fintechs that come to us that want to get our customers' data, we're okay with handing it over to them, but we're going to charge them for that. And that was one of the big issues with open banking was the fact that there was no monetary incentive whatsoever for banks to do this. Like it was going to be a major cost. Now they were trying to sell. The big sell on open banking is that it's going to give you, the consumer, much more control over your data. I've always, and I will continue to keep asking the question: how does giving your data to Google or Meta or Amazon or PayPal, how does that give you more control over your data? If you hand all of your banking data over to these companies, how does that give you more control over your data? And the answer is it doesn't. It gives you zero control over your data. So JP Morgan comes out and says, oh, yeah, you know what, we'd be open to that. And then the CEO of PNC Bank comes out and says, yeah, you know what, that's a pretty good idea. We like the fact that we could charge and make money off of that and make that basically a permanent revenue stream for the bank. We like that. That's great. So now the CFPB is actively meeting with stakeholders to discuss potential revisions to the open banking regulation, showing an openness to allowing lenders to charge for access to customer data, Bloomberg News reported, citing people with direct knowledge of the discussion. But wait, it gets much worse. Additionally, the CFPB is exploring whether third-party companies can access customer accounts without requiring explicit permission for each instance, addressing banks' concerns about frequent data requests, unnamed sources told the news outlet. In other words, the big banks were going, man, they were, all these consumers and all these other people, these fintechs were constantly going to bother us for the information. And we really didn't want the hassle. We didn't want to be bothered by these people. We just, hey, we're just going to set up a portal and let them pay. And then they just get the information because we don't care. So, I mean, this is just an insane 180 by the CFPB. I don't know who's running things at the CFPB right now. Russ Vogt was over there. Russ, what are you doing, man? What are your people doing over there? I don't understand this. We went from this thing is dead and we're going to kill it to now all of a sudden it's oh no, this is cool. We're going to change the rule up. We're going to put it through. We're going to let banks charge for this. And you know what? That little pesky thing about, consumers having to give permission or having to ask the banks for permission. Yeah, we're just going to get rid of that. We're just going to get rid of that altogether. That's just going to go and forget that. Basically, Google or Apple or whoever will just be able to back the door up right to the bank, suck out all your personal private bank data as long as they're paying for the bank for it. Hey, that's awesome. It's just, I mean, this is a nightmare. This is a nightmare and it's horrific. And I just let me read that again. The CFPB is exploring whether third-party companies, meaning Google, Apple, Meta, PayPal, Block, anybody, you name it, X, you name it, it's anybody can access customer accounts without, and I emphasize that word, without requiring explicit permission for each instance. In other words, that nobody has to ask for it. They just go in and pay for it and they're going to get it. I can't even begin to fathom how many how many parts of the Constitution this violates. Fourth Amendment. It's got to be Ninth Amendment, 10th Amendment. Is a ton of amendments that this has to violate. And I would hope and pray that there will be lawsuits galore from people. And it was funny listening to the FinTech Association, who they're the ones who were filing the lawsuits in court to basically say, no. The 1033 rule, the open banking rule, it has to go through. And then, Jamie Dimon came out and said, yeah, we're going to start charging for the data. And then they lost their minds and were like, oh my gosh, what do you mean? You mean we're not going to be able to get that data for free? That you're going to actually make us pay for it because we're going to make a ton of money off that data. You expect us to pay for it? No. Not only do we want the data, not only do we expect you to just hand it over to us, we expect to get it for free. The whole conversation is insane. And yet this is what's going on, which is it's just wild to see this. So, all right, let's sorry guys, got to get down off my soapbox there for a minute, but it's so important. I have been pressing all year long my hot button topics were the 1071 rule, because that was going to force banks to give all kinds of information about small business customers, the beneficial ownership information, and open banking. And again, a lot of people try to look at those three things as individual topics. No, you've got to look at the bigger picture. You got to look at all three of those things together. They all add up together as just a massive invasion of your privacy, as cash grabs, as violation of all of your data. It's just, it's just wild. It's mind blowing. And, and even though the beneficial ownership information, even though the whole idea of the database has been put on the side, that thing hasn't been completely killed. And if a Democrat administration gets back in there, they could bring it right back. And banks still required to collect beneficial ownership information on everybody. So that's not completely dead. The 1071 went from, oh, we're going to get rid of it, to, okay, now we're going to make adjustments to it. Just like the same thing that just happened here with open banking. It went from, oh, it's dead, to, oh, you know what? Now we're going to make revisions to it and bring it back. I mean, these things they're terrible. It is horrific government overreach in its worst forms. And it's just mind boggling. It's mind boggling to me. And I just, again, I'm hoping and praying that, people start to educate yourselves, to start to look up this stuff, because it is important, man. It's all of your information. It's everything you hold dear, being all out there to anybody who wants to buy it. And it's terrible. It's terrible. All right. Anyway, okay. So this week, mortgage rates continued to fall, which is good. 30-year fixed rate mortgage was down to 6.63%. That's great. Consumer credit increased in June. That's good. Wholesale inventories also increased in June. So we saw that. That was fantastic. Just want to make sure, okay, didn't miss anything there. Let's see here. So weekly mortgage applications increased. That's great. They were up by 3.1%. CISA releases malware analysis report for SharePoint vulnerabilities. The Cybersecurity Infrastructure Agency published a malware analysis report on files related to Microsoft SharePoint vulnerabilities, and encouraged organizations to use the indicators of compromise and detection signatures to identify malware. So obviously, that's a big thing. Judge rules the Fed's cap on debit card swipe fees is illegal. A federal judge ruled that the Federal Reserve's cap on debit card swipe fees is illegal. So that's I think that's a good thing. Service sector index increases in July. FinCEN grants exemption to investment advisor rule requirements. So the Financial Crimes Enforcement Network issued an order that grants exemptive relief from the rule to establish anti-money laundering, countering the financing of terrorism, and suspicious activity report requirements for registered investment advisors. So investment advisors are getting a little bit of a reprieve there. But I think the rule will still take effect on January 1st, 2028. So FHFA doubles what enterprises can invest in low-income markets. So the Federal Housing Finance Agency announced that, consistent with the One Big Beautiful Bill, it is doubling the amount that Fannie Mae and Freddie Mac can invest in low-income housing tax credit properties, from $1 billion to $2 billion each year. Great thing. It's good. Agencies release resolution plans for large banks. So the Federal Reserve and FDIC released the public sections of resolution plans for 8 largest and most complex domestic banking organizations and 56 foreign banking organizations. So there you go. FDIC updates approach to pre-filled customer information. So the FDIC announced it is updating its supervisory approach regarding whether banks can use pre-populated customer information for the purpose of opening an account to satisfy customer identification program requirements. So again, very interesting looking at that there. ICBA opposes Ripple's application for a national trust bank charter. So this is very interesting. So ICBA expressed opposition to blockchain tech company's Ripple's application for a national trust bank charter for its proposed subsidiary, Ripple National Trust Bank. So again, this is interesting. I think this is going to be A little bit of a knockdown, drag out fight, and we will see what happens with that. I'll keep everybody updated as that plays out. Bank financial officers report tighter standards for commercial loans. So respondents to the Federal Reserve's latest survey of senior financial officers shared their opinions on the standards and terms on and demands for bank loans to businesses and households over the past 3 months. Basically, they reported that tighter standards and weaker demand for commercial and industrial loans to firms of all sizes over the first quarter, and tighter standards and weaker demand for all commercial real estate loan categories. So that's interesting. I'll actually be covering that report in an episode I put out probably this week in more depth, so keep an eye out for that. FinCEN issues warning about convertible virtual currency kiosks. So FinCEN urging financial institutions to be vigilant in identifying and reporting suspicious activity involving convertible virtual currency, or also known as CVC kiosks. So interesting. SEC creates an AI task force. So the Security and Exchange Commission announced the launch of a task force on artificial intelligence that will spearhead the agency's efforts to enhance innovation and efficiency in its operations. American Bank, credit unions are buying more banks. Yes, we talked about that earlier. So basically, in this article, they said that, oh, yeah, credit unions are buying more banks. They're complaining about, again, the tax treatment, which we talked about back at the beginning of the show. Farm credit lender sues businesses for failed non-farm loans. So the Farm Credit System lender is suing a Tennessee distillery after the enterprise's non-farm commercial loan to the business has gone south, according to a local media report. So interesting. Construction spending declines in June. Manufacturing activity contracts in July. Consumer sentiment edges up a little bit in July. So a little bit more economic indicator information. American Banker reports on growing credit union concerns. Again, yeah, more issues on the credit unions there. And this was a good one. ICBA advocated bill restricting mortgage trigger leads passes Senate, heads to the president's desk. So the Senate passed ICB advocated legislation restricting credit reporting agencies from selling consumers' contact information when they apply for a residential mortgage. That is a huge thing. I'm hoping that the president signs that very, very soon. The sooner the better, because it does take a little bit of a process to get the law in place once it's been passed. But the trigger leads is a very big thing. I've been talking about that for a number of months. And for anybody who doesn't know or is not aware of the trigger leads thing, so what happens is you go to get a mortgage. You apply for a residential mortgage. The bank pulls what's called a tri-credit bureau report. So they're pulling from the three main credit bureaus. They're pulling from Experian, Equifax, and TransUnion. Now, the minute they pull that credit report, they pull that tri-bureau credit trifold report. What happens is those credit reporting agencies sell that information, and then you start getting crazy phone. Like you'll get literally 100 phone calls in a half hour, and it'll be from all these different banks from all over the country. Hey, we got a better deal for you. You know, come, don't go with the bank you're doing. Come talk to us, whatever. Now, when this happens, the big problem was everybody thought that it was the banks that were doing this. That banks were causing this problem. Banks were doing this. No. Banks had nothing to do with it. No bank in the country participated in this. No bank in it did this. This was all the credit bureau, the credit reporting agencies themselves that were doing this. Why they thought this was a good idea, just the fact that they have been unaccountable to anybody has just been kind of wild. The fact that nobody from Congress has called these guys on the called the CEOs of these companies on the carpet and basically said, what are you guys doing? Why are you doing this? Why are you doing this to people? Just so you guys can make a few extra bucks. I mean, it's absurd. It's ridiculous. But anyway, so hopefully we got this trigger lead law passed, which will kill this thing, stop all that nonsense from happening. And hopefully that gets put through sooner rather than later. So, all right. That's the banking news I had for you guys. So let's get back to some other articles here in the time we have left. Oh my gosh, man, I got so much stuff left to go to. You guys got like another 3 hours, right? Like I literally have that much stuff that I could sit here for another 3 hours talking about all this stuff. Man, and it's supposed to be August. This is supposed to be, quiet time in the financial world. Um, all right, let's run through all the revenue stuff real quick. So the first thing I wanted to go through, and I just love this because it's so beautiful, beautiful. Trump's tariff revenue smashes record with 28 billion haul in July. Collections top 151 billion for the fiscal year to date as Trump's trade policy enters a critical phase ahead of the August 1st reciprocal tariff deadline. Now, this article is from about a week ago, but again, why aren't you have to ask yourself the question, why are you not hearing this on TV? Why are you not seeing this on CNBC? Why are you not seeing this on Bloomberg? Why are you not seeing this on Fox Business? This is huge. He's brought in $151 billion in tariff revenue. It's the most tariff revenue that this country has seen in decades. And he's bringing it in. And nobody said, it's all the fear mongering about, oh, the tariffs are going to wreck the country. They're going to create all this inflation. They're going to do this. Yeah. All it's done so far to this point is bring us an insane amount of record revenue. And again, I keep harping on this. Why is the news media? Why will they only do the fear mongering, but they won't talk about the massive benefit that we're seeing from this? And they're projecting that again, if this keeps going this way, we're going to start to have annual tariff revenue of between like $500 and $600 billion annually. You're going to see the trade deficit shrink back. The trade deficit was almost $1 trillion, which was horrible. That in and of itself was bankrupting the company or the country. If you could get that, and again, you don't have to get the trade deficit back to zero, but if you could get that back down to maybe 300 billion, 400 billion, get it back to kind of a reasonable level, then, okay, it's great. And then you put that together, you see this shrinking of the trade deficit and this massive increase in the tariff revenue. That's a massive win for our country. That's an economic massive win. So again, I just can't stress this enough. I mean, this is great news. Tariff revenues hit a new monthly record in July, topping 28 billion and lifting collections for the fiscal year to more than 151 billion, according to Treasury data. The latest daily Treasury statement released on July 29th shows July's haul surpassed the previous record of 27 billion set in June. President Donald Trump said the highest duties will substantially boost government revenue. The big money will start coming in on August 1st, he said during a July 8th cabinet meeting, referring to reciprocal tariffs scheduled to take effect against dozens of trading partners unless they strike last-minute deals with Washington. So again, we're going to take a look at this. I got a great chart, graph, interactive graph, basically to show everybody in just a second. But then this was from the Wall Street Journal. The tariff effect, billions in revenue, but no economic earthquake. So even the Wall Street Journal is admitting at this point that this is going pretty good so far. U.S. tariffs are higher than they have been in decades. Their effects have been mild. And of course they always got to poo-poo everything, right? They always got to, put the kibosh on it, Trump's tariffs intended to reshape the economy has so far only caused minor disruptions, with inflation ticking up slightly. No, actually the inflation ticking up actually zero. President Trump and his critics have described his tariffs as an earthquake that would transform the U.S. economy. So far, the impact has been mostly a series of tremors. In recent months, the president pledged, and again, I show you guys these articles to show you how ridiculous some of this writing and this reporting are. In recent months, the president pledged that a new tariff regime would slash the trade deficit and force manufacturers to move production back to the U.S. His detractors warned that the tariffs would spark inflation and even shortages in stores as soon as this summer. 6 months into the it's an experiment, right? Not proven economic theory based on 300 years, but it's an experiment. With more tariff announcements likely in the coming days, the economy hasn't crashed. Shocking. Inflation has ticked up, but not soared. Consumers aren't finding empty shelves. Yeah, no, you know what? But again, these articles are just ridiculous. They just can't admit they just can't admit that they were totally wrong and that their fear-mongering was a joke. All right. Now, obviously, the big trade deal announced this week was with Apple. Trump announces that Apple's additional 100 billion U.S. investment plan on top of the 500 billion that they had already committed to the U.S. So now we've got a $600 billion investment. Can I ask anybody a question? Under Biden, did anybody make a $600 billion investment? Anyone? Any company? Any company in 4 years? No, nothing even close. And Apple's not the only company. I mean, Trump has lined up trillions. Like, I think it's over $3 trillion now of pledges from companies to bring back production, manufacturing, intellectual property development, like all kinds of stuff back to the U.S. Trillions of dollars of investment. And it's amazing. It's amazing what he has been able to do in just 6 months. President Donald Trump announced on August 6th that Apple will increase its U.S. investment commitment by an additional $100 billion, which comes on top of the more than $500 billion in investments that the tech giant unveiled in February for the next 4 years. These investments will directly create more than 20,000 brand new American jobs and many thousands more at the Apple suppliers like Corning, Broadcom, Texas Instruments, and Samsung, Trump said in the Oval Office. As part of this historic commitment, Apple will massively increase spending on its domestic supply chain for the iPhone and will build the largest and most sophisticated smart glass production line in the world in Harrodsburg, Kentucky. Trump called Apple's new investment a significant step toward his long-standing goal of bringing iPhone production to the United States. As part of its $100 billion expansion, Apple will also build a 250,000 square foot server manufacturing plant in Houston and invest billions in new data centers nationwide, including in North Carolina, Iowa, and Oregon. The tech giant will also open a manufacturing academy in Detroit. So how many states is that affecting now? You've got Kentucky, you've got North Carolina, you've got what else? Iowa, Oregon, Detroit. This is massive, man. And these are good jobs. These are high paying, good jobs. This is not Walmart jobs here. This is not fast food jobs. These are real jobs, great jobs are going to be created here. And again, as I told everyone back in January, this whole thing was not going to be done in a day, a week, a month, or 6 months. This is going to take a couple of years. I said it was going to take probably the better part of a year for him to renegotiate all these trade deals. Like, this was not going to happen overnight. And I've said it repeatedly. There are going to be fits and stops and starts. Lunges and fits. There's going to be a lot of back and forth in these negotiations, as I'll show you here in just a second. But so now we had the big trade deal with Apple announced, or the stuff coming back a little bit. But now we got Trump's August 7th tariffs take effect. Here's what to know. So based on the president's latest comments, more tariffs are coming. And oh, baby. President Donald Trump's new tariffs on dozens of countries went into effect at midnight on August 7th. The country-specific levies were initially scheduled to begin on August 1st, but the administration pushed back the start date to finalize the tariff regime. Under the executive order, almost 70 U.S. trading partners will face tariff rates ranging from 10% to 41%. However, goods already shipped to the U.S. ports before the tariff start date are exempt from duties if entered for consumption by October 5th. Transshipping goods, products manufactured in one country and rerouted to another market to avoid tariffs, will also be subject to a 40% import duty and other fees and penalties as per the directive. The president's executive order codifies his reciprocal tariff rates unveiled 4 months ago and later paused for 90 days to allow for negotiations. So in other words, all of these countries either didn't bother to negotiate or didn't take it seriously or whatever. They woke up to a big shock this morning. Big shock. Okay, now here's the interactive little map here that I was telling you about. So this is called Trump Sets New Tariffs, Extends Deadline, What to Know. So the United States has finalized tariffs on more than 60 countries, which will take effect on August 7th. So let's see here. In what's that? Kind of like a yellowy color. We have new rate. In blue, we have trade deal, and future deadline is in red. And then the baseline is in kind of like a baby blue color there. So the new rate here, all this is in yellow. So what do we have here? Canada, 35%. Let's go down here. Brazil, 50%. Obviously, there's some political things in that going on in Brazil, so that's a little bit more than a lot of these other places. Venezuela, 15%. Guyana, 15%. Bolivia, 15%. Ecuador, 15%. Nicaragua, 18%. Costa Rica, 15%. Let's go over to Africa. Algeria, 30%. Libya, 30%. Tunisia, 25%. Chad, 15%. The Democratic Republic of the Congo, 15%. Angola, 15%. Let's go over to Middle East here. Iraq, 35%. Turkey, 15%. Let's go over to Kazakhstan, 25%. Let's go up to Norway, 15%. Also Norway up there. Let's go Iceland, 15%. India, 25%. Talk about that one in a second. Pakistan, 19%. Afghanistan, 15%. What are some of the obviously new trade deals with the European Union got announced over here? Indonesia, what do we got? Japan, Vietnam, Philippines, Laos, Japan, South Korea. They all came to the table smartly. Future deadline here, obviously Mexico got pushed back, I think, a little bit, and China got pushed back a little bit. And then the baseline, who got hit with the baseline? So, Russia got 10%. I think all these countries with the baseline were 10%. Australia, Russia, Saudi Arabia, Yemen. So basically everybody's getting that 10% flat across the board, right? So everybody gets the 10%, and a lot of these other countries are getting hit with bigger. Now, let me ask you just a question. Is this going to be the final thing? No. This is not going to be the final thing. Obviously, a lot of these countries are going to get smacked with these big tariffs. They're going to come back to the table. I think Brazil is the funniest with Lulu down there just crying like a chump down there. Just we need to decentralize and get off the dollar or whatever. Yeah, okay, good luck with that, dude. Yeah, good luck with that one. He's gonna get ground stomped here. And he's gonna get a taste of this, and he'll be back shortly to renegotiate. You mark my words. Canada, I don't get Canada. I don't know. I just the brain damage in Canada right now is just dumbfounding to watch. I don't get it, and what's amazing is that none of this had to be like this. Like all these countries had to do was come back and negotiate, and they could have got deals like what Europe, what the United Kingdom got, what Europe got. Now they're gonna get bad deals for themselves, not for us, for them. Sucks. Let's see here. EU will delay planned U.S. tariffs for 6 months to allow for trade talks. So the European Union will suspend its planned countermeasures to President Donald Trump's tariffs, which were set to take effect on Thursday. The suspension marks a concession from the 27-member bloc, which is among the United States' largest trading partners. The announcement comes after weeks of trade negotiations between Trump and European Commissioner President Ursula von der Leyen. So the EU is acquiescing and going through, and they got we got an awesome trade deal out of that. Trump says pharma tariffs could eventually reach up to 250%. So President Donald Trump told CNBC Squawk Box that planned tariffs on pharmaceutical imports into the U.S. could eventually reach up to 250%, the highest rate he has threatened so far. He said he will initially impose a small tariff on pharmaceuticals, but then in 1 year to a year and a half maximum, he will raise the rate to 150% and then 250%. So that's awesome, man. Awesome. Bring those drug prices down, baby. Trump imposes new 25% tariff on India for buying Russian oil. So President Trump will impose an additional 25% tariff on India as part of his efforts to pressure Russia. The White House said Wednesday that it will implement the tariff on August 27th because India continues to purchase oil from Russia. The tariff will stack on top of the 25% reciprocal tariff that will go into effect on Thursday. So basically, they're getting hit with a 50% tariff. So foreign semiconductors to face tariff of approximately 100%. Trump. The president said manufacturers can avoid the tariffs by building in the United States. So President Donald Trump announced on August 6th that tariffs on semiconductors and computer microchips will be as high as 100%, but indicated that companies could avoid the tariffs by committing to building facilities and making products in the United States. We'll be putting a tariff of approximately 100% on chips and semiconductors, Trump told reporters. But if you're building in the United States of America, there's no charge, even though you're building and you're not producing yet. It's unclear whether the tariffs will go into effect. So we shall see what happens. That's obviously a very big one, and we'll keep an eye on that one. So a couple of articles here on China real quick. So China's exports keep defying expectations with accelerating growth in July. So exports to the U.S. fall for a fourth consecutive month, but rise for the rest of the world. So China's exports grew 2.7% in July, outpacing June's 5.8% increase, despite U.S. tariffs, but trade with the U.S. has fallen. So, and then we go back to, so China is choking supply of critical minerals to Western defense companies. Beijing's tightened controls are a sign of leverage it has over the U.S. military supply chain. So China is restricting exports of critical minerals, causing delays and price increases for Western defense manufacturers. So China is limiting the flow of critical minerals to Western defense manufacturers, delaying production and forcing companies to scour the world for stockpiles of the minerals needed to make everything from bullets to jet fighters. So obviously not good, but White House ramps up efforts to eliminate China's chokehold on rare earths. So a minimum price guarantee offered to the domestic rare earth sector could significantly accelerate the timeline of reaching U.S. supply chain independence. So the White House plans to expand its support for domestic rare earth businesses to counter China's near monopoly on rare earth minerals. So senior officials informed a group of rare earth companies at a recent meeting that the Trump administration intends to form public-private partnerships to boost domestic production and extend a minimum price guarantee to their products. A White House official confirmed on July 24th, meeting with the Epoch Times on August 1st, Reuters first reported the development. So the U.S. government support for the rare earth sector would be similar to a recent investment deal with MP Materials, the company that owns the only active rare earth mine in the United States. So, yes, obviously critical to our national security that we ramp up rare earth mineral production and get that going. Because, yeah, I mean, if a war breaks out, you know, man, that will be very rough on us. That is for sure. Okay, do I have time to get into a couple other things? You know what? Well, I'll tell you what. I'll do these last couple things here. Just kind of end on this here. So, federal judge reverses Biden-era rule that barred medical debt from credit reports. So, the judge found that the CFPB exceeded its authority when it tried to ban medical debt from credit reports, striking down the rule before it could take effect. A federal judge in Texas has struck down a Biden-era rule that would have barred medical debt from appearing on credit reports. In a July 11th order, District Judge Sean Jordan of the U.S. District Court for the Eastern District of Texas found that the Consumer Financial Protection Bureau, CFPB, overstepped its authority when it finalized the rule in January, 2 weeks before President Trump was sworn in for a second term. Under the Fair Credit Reporting Act, credit reporting agencies are allowed to include medical debt information in credit reports, providing the data is coded to conceal details such as the medical provider's identity or the nature of the treatment. Creditors are permitted to consider this coded medical debt information when making lending decisions. Okay, and then the last one here was another related thing. Push to add buy now, pay later loans to credit scores hits a snag. Klarna says it plans to withhold data until it is assured its customers won't be unfairly penalized. So again, so Klarna and Afterpay say they're withholding their buy now, pay later customer data from credit bureaus until they get assurance their customers won't be unfairly treated or penalized. Credit scores are supposed to start incorporating buy now, pay later loans this fall. The plans may already be hitting a speed bump. Klarna, one of the biggest providers of the popular loans, said it wouldn't share the data about the bulk of its loans with credit bureaus until it gets assurances that its customers won't be unfairly penalized for using its payment options. Buy now, pay now provider Afterpay has also said it plans to withhold data until it has proof its customers won't be harmed. Credit reporting, scoring, and interpretation still largely operate under legacy frameworks. Well, here's the problem for those guys. They don't really get to decide that. And it bothers me that they would come out so strongly. Now they're doing this in the guise of, oh, we're doing this to protect the consumer, right? We're doing this to protect our customers. Well, maybe they're just doing it to protect themselves, because maybe there is a whole lot of delinquency there that they don't want people to see. Maybe they don't want people to see what the actual real repayment history is on the buy now, pay later products. Maybe that could be one of the things that's going on here. So again, just, between this and the ruling on the medical debt, so a couple things there that basically can affect people's credit scores. Obviously, I'm sure there will be more to come on this. So, I'll report on this as we, as we go through. But okay, I'm going to cut that off. So what I'm going to go to, I always end with, I've got a story of the week and I got a quote of the week that I always give everybody. So let's see here. What do I got here for the story of the week? I've been doing some other things there. All right, let's do, you know what? We will do our story of the week this week. We will do the Dow Jones Industrial Average. So the Dow Jones Industrial Average, also known as the Dow 30, is a stock market index that tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange and the NASDAQ. The Dow Jones Industrial Average is named after Charles Dow, who created the index in 1896, along with his business partner, Edward Jones. The Dow Jones Industrial Average is the second oldest U.S. market index. The first was the Dow Jones Transportation Average. The Dow Jones Industrial Average was designed to serve as a proxy for the health of the broader U.S. economy. The composition of the 30 members of the Dow Jones Industrial Average has changed over time with the addition of several high-tech firms such as Apple, Salesforce, and Cisco. Warren Buffett recently noted that many of the top-performing Dow Jones Industrial Average companies from 20 years ago are no longer a part of today's index, notably such energy and industrial and financial stalwarts as ExxonMobil, General Electric, and Citigroup. First published on May 26, 1896, the first Dow average was Dow Jones Transportation Average, established 12 years earlier in 1884. At its inception in 1896, the Dow Jones Industrial Average contained just 12 companies from a single sector, industrials. General Electric is the sole company that remains a Dow component to this day. In 1916, the index was expanded to include 20 stocks and then further expanded to 30 in 1928. The index first hit 1,000 in 1972, 76 years following its inception. The founder, Charles Dow, who founded Dow Jones & Company in 1882 and serves as chief editor of the Customers Afternoon newsletter, the precursor to the Wall Street Journal. So it's just some interesting finance facts there on the Dow Jones Industrial Average. So that's our story of the week. And then what is our quote of the week here? Okay, so this comes to you from Alexandra Dumas. So this quote goes, "Learning does not make one learned. There are those who have knowledge and those who have understanding. The first requires memory and the second philosophy." So I love Alexander Dumas. He wrote one of my favorite books of all time called The Count of Monte Cristo. Also wrote The Three Musketeers. Just an incredible author. Love The Count of Monte Cristo. If anybody's has never had a chance to read that, I highly suggest reading it. Edmond Dantes, one of my favorite literary characters of all time. Yeah, just a phenomenal book, phenomenal story. If you could watch the movie too, there's been a number of versions made of the Count of Monte Cristo over the years. Okay, so just a couple things to note real quick. If you are listening to the podcast on Apple Podcasts or on Spotify, please leave me a review. I definitely, I've been searching for some more reviews out there. So if you get a chance, if you're listening on one of those podcast platforms, please leave me a review because that would help me immensely. If you haven't been to thebankernextdoor.com, please go to the website and check it out. We got a lot of great stuff on there. You can search old episodes. You can see, some current news, blog posts, other things that are up there. So, go on and check out the website at thebankernextdoor.com. And with that, I'll basically wrap up by saying, if you like what you're seeing, if you're liking the live stream, if you're liking the episodes, please make sure to like, share, and subscribe, as that always helps the channel. Remember, if you subscribe to the channel, I do put out posts on YouTube. So, I post out what all the episodes are coming out during the week. If there's some kind of change to when the live stream is going to be coming on, I put out like what topics we're going to be covering that week in the live stream. So I put out, I love the posts on YouTube. I put out a lot of posts. So subscribe to the channel so that you get the posts and you can get the most up-to-date current information and keep track of what's going on here on the channel. And just remember, we're on YouTube, Rumble, and all major podcast platforms. Leave your comments. As I always love getting back to everybody. And as I always ask everybody, please just make sure to check out some of the other content on the channel. If you've never checked out the crypto series or the Lords of Easy Money or any of the interviews that I've done, a lot of great content on there. If you go to the YouTube page, everything is categorized and broken down, so it's easier to find what you might be looking for in particular. But with that being said, I hope everybody has an awesome week out there. Have a great weekend. I will be back normal time next weekend, Saturday night, 8 p.m. You'll be back in the strategy room with me. But until then, have a great time out there. Great weekend. I will see everybody again real soon. Thanks for listening.